Hello, welcome back to my channel. I'm Anthony Galeano. I'm a realtor here in West Los Angeles, California, and I'm really happy that you're stopping by to say hello and to see what I have to share with you. I would love for you to subscribe to the channel and hit the like button if you like the video and the notification bell if you like to be notified of future videos. Just so you know, I'm trying to do one video a week and I'm staying within the subject of real estate. So if you like to learn more about real estate, I would suggest that you follow me, you subscribe to the channel and like the video, and that's also shows me that you enjoy my content. I wanted to share today what a contingency is in real estate, because many times I think that people don't understand why they really need an agent by their side. And the reason is because this is a serious negotiation that is going on here. You're negotiating to buy a house and you're putting a substantial amount of money. Sometimes some agents request that the buyer places a substantial amount of money that if the contract does not happens, if it doesn't close because something you did wrong, then you will lose your earnest deposit, basically the money that you put into this agreement. So basically entering into a contract is a binding agreement. If you don't perform, if you don't close, if you don't do what you need to do, then you could end up losing money. And sometimes it's a substantial amount of money depending on how much money you're putting down. So how do we deal with this as realtors? Also, before I continue, I want to say that also for the seller, not just for the buyer, but for the seller, it's also important that the property sells, because if the buyer does not perform for whatever reason, then this property goes back on the market. And just think about this. For example, you put a house for sale, you get an offer, you accept the offer, you move the house out of the market because it shows pending now. You're pending the house because you're thinking that it's going to close. 30 days down the road, you find out that the buyer cannot perform, and so doesn't sell, and now it goes back into the market. Now that's very costly for you, the seller, as well, because first of all, you lost all that time. But second, people that are watching this property are going to say, well, why didn't the property sell? Was it too high? Was there something wrong with the property? And it starts to create doubt, and it creates a stress on you as a seller, because the longer the house stays on the market, the more that you tend to lose, because people are thinking all the negative things. People don't always think, oh, you know what, maybe somebody came and wasn't able to afford it. No, they're thinking something is wrong with the property, and that's why the buyer walked away. So contingencies, which is what I want to talk to you today, is something that we incorporate into the agreements so that you have a way out or a way to check what's going on. And these contingencies are very, very important, not only for the buyer, but also for the seller. And so it's kind of, a negotiation that is put on paper. And if something doesn't happen, you're able to walk out of that contract. And for the seller as well, if something does happen, then you're able to keep that earnest deposit as some kind of incentive or some kind of payment for the time that you lost and all the aggravation and all the time spent on that transaction. So it's very good to have a good agent that knows what he's doing for you, either if he's representing the buyer or representing the seller. In real estate, we are able to do something called dual agency, where we represent the buyer and the seller as well. Even though there is a conflict of interest in a way, we are able to do it, but the Department of Real Estate doesn't really recommend that you use the same person to do both sides, because it just creates a little bit of tension, because you don't know if you're working for the buyer or the seller, even though technically, I have to clarify this, technically, even the agent who represents the buyer is always working for the seller because the seller pays the commission. But of course, we have a duty and we have to make sure that everything is done with the utmost care and due diligence, and we have to do all these fancy words that are taught to us in real estate so that the transaction is as clear and as perfect as possible without any kind of headaches in between. So without further ado, I'm going to go into what a real estate contingency is. So basically, a real estate contingency is a clause in a purchase agreement that specifies an action or requirement that must be met for the contract to become legally binding. So that's what it's a clause. It's something in the agreement that specifies that something has to happen for the agreement to become legally binding. Now, the buyer and the seller must agree to the terms of each contingency and sign the contract before it becomes a binding contract. The contingent contract gives both parties some wiggle room if the conditions are not met. Contingency clauses safeguard buyers and sellers by giving them the right to cancel a contract if the terms are not met. Now, this is a good thing because you could walk out, and this also helps, like I was mentioning before, both of you. So now let's talk as a buyer. Okay, I have a buyer and he's nervous because he doesn't know if this house is really in a perfect state. So the first thing I want to talk about is what I always talk about, which is the contingency of checking the property, or what we call inspection contingency. So an inspection contingency is something that I recommend to my buyers, and I always say you have to do an inspection contingency, because if you don't inspect the property, then you don't know what's wrong with it. And then not only is he buying something that might be damaged, he may have some issues later, but these issues can come back to the agent as well, because they're going to say, well, Mr. Agent, how come you didn't tell me to do an inspection? Now the roof is leaking, something is damaged, electricity is wrong. I mean, you need to tell the buyer this is a big investment, and therefore I recommend that you do an inspection. No negotiation on that. I mean, just pay for the inspection. It's better if you pay for the inspection, because that way you can see what's wrong with it, and maybe you can come back and negotiate with the seller and say, hey, Mr. Seller, I have a problem here. You know, the roof is about to collapse, or, you know, something is wrong. And so I need you to give me some credit for that or reduce the price. And at the same time, if we flip it to the other side, many agents tell the sellers, hey, Mr. Seller, before you go forward and put this house on the market, why don't we just spend some money on doing the inspection and see what it looks like? Because for the seller, if you do the inspection, you have a tool at your disposal that you can present to the buyer. And now the buyer has no excuse to come back to you and say, hey, I want to reduce the price because I found ABC. You see, it's really a tool for both of you. So if the seller does it, and I'm representing the seller, I'm going to tell the seller, you know what, we should do this because it puts you in a better position. And for the buyer, it also puts you in a good position. So it's a win-win situation, either way you see it. Okay, so that's a very good, and it's contingent to that if something is wrong, you get out. So as a seller, again, if you have that in place, it limits the opportunity for that buyer to walk away from the deal. Okay, now we have the second, mortgage contingency. What is a mortgage contingency? Okay, that's a contingency that basically says if the buyer cannot get the loan, he doesn't buy the house, he just walks away. So there's certain amount of days that seller and buyer's agents agree, unless they take the standard in the contract. But if they agree to a certain period for that buyer to secure the loan, then it's a win-win situation. If the buyer doesn't get the loan, the seller already knows, I'm giving you 2 weeks, I'm giving you 21 days, I'm giving you whatever time it is for you to get that loan. Now, I know that if at this day you have not told me that you got that loan, we're gonna remove contingency. So it's something that I experienced many times when I'm negotiating with a seller's agent. He's like, okay, Anthony, are we removing loan contingencies? And it's a very nerve-wracking situation if the loan is not yet done because you're representing the buyer. So you're asking, hey, can we extend that, a few more days because, the buyer or the loan officer hasn't has not guaranteed the fact that this guy's gonna get a loan. So basically, I'm rooting for my buyer and trying to defend that buyer, trying to stay in the deal a little longer. But worst case scenario, he says no. Seller's agent says no. I don't want to risk this guy's money. I don't want to risk his earnest deposit. I'm just gonna say, well, you know what? Okay, let's walk away. We can get the loan. We can get the loan. Of course, with that said, every agent wants the deal to happen, and every seller and buyer wants the deal to happen. It's like we all want this to happen. It's not like we're trying to, pull a fast one here. We want this thing to happen. The next thing is title contingency. Okay, why do I want to have a title contingency? Well, because I want the title to be clear and also insurable, because title insurance is not going to insure the title unless it's clear. So I want that title to be clear, crispy, clear. So when it transfers to my buyer, there is no issues. There is no cloud title. There is no lawsuits. There is no other owner saying that he owns that property. There is no one from a trust suing that property. It's nothing happening. There is not a lease pendens, which means that there is a lawsuit. There is nothing happening. There is not somebody suing because there is an easement or something on that property. So I want that title report to be clear as crystal so that we don't have any issues. So the contingency of title is very, very important because you don't want any issues when you transfer title. The appraisal contingency is another contingency that's very, very, it's very important because think about this. You sell me your house for $700,000 and I'm going to go to the bank and I'm going to ask for, if I'm putting 5% down on the $700,000, so I'm going to take out the $35,000 that I'm putting down and I'm applying for a loan for $665,000, and that property has to appraise for that $700,000. No ifs or buts. The bank is going to send an appraisal that I don't even know. No one knows this guy. He's going to come there. He's going to measure. He's going to look at the house. He's going to look at comparable sales, and he's going to do his work. And he's going to say, boom, it appraises. He says, as an appraisal, we have value. We can continue. He says the house appraises for more. Well, beautiful. The house appraises for less. Now we have a problem, because if the house appraises for less, we can get a loan. So if we can get a loan, we got no deal. So that contingency has to be part of the deal. And then, if that happens, then what are the things that you can do? Well, Mr. Seller, your house is not appraising at what you're asking. I'm sorry, it's not. So I think you need to reduce the value in order for us to buy. Now, in a seller's market, I've seen situations where sellers are so desperate to get the property that they actually come out with the extra cash and pay that surplus. But in a buyer's market, which is where we are right now, I don't think anyone is going to do that. I mean, I wouldn't do it. Would you? Okay, the next thing will be the homeowner's insurance contingency. That means that I'm not going to have any issues insuring my house. I mean, if something is wrong with that house and it's non-insurable, then I don't want to do a deal, because, if something happens to the house, what am I going to do? I need to insure that house. Plus, the bank who is giving that loan has a requirement. I want you to insure that house. The bank doesn't want to lose their money. So we need to have clear title. We need to appraise the property at the value that they're asking. We need to insure that house. So insurance is very, very important. And so the bank is going to say, either you buy the insurance or we put the insurance in there, but it has to be insurable. In fact, one of the things that happens most often when people tries to buy fixer-uppers, a lot of times it happens. It has happened to me with buyers where they're like, oh, give me a deal of a fixer-upper, give me an REO, real estate owned property. And then you have to explain to them, unless you're buying this deal all cash, something is wrong with it. It's not insurable unless, we have everything in the house done towards where it can be insured. But if it's not insurable, then the bank is not going to give you a loan, and you're just wasting your time. That's why a lot of times you see that when you sell a property for investors, you almost always have all cash. Of course, I'm not going to get into this, but there is hard money loans, and there is bridge loans, and there's all kinds of loans for investors that want to purchase this type of property. Of course, higher interest rate, and of course, a lesser amount of time for you to pay that loan. Now, did I cover that? I think I covered all the ones I wanted to cover. So the sale of a prior home contingency, I think I didn't talk about that one. And the sale of a prior home is when you want to buy a house and you list your house for sale, and you said, okay, I'm only gonna sell this house if I find a house that I like, that I can buy. So this sale is contingent to me finding another house. So if I don't find a house, this house is not, I can get out of the contract, there is no deal. But it's part of the deal. So that means this house is contingent to me finding another house. So I can put the house on the market, I can get an offer, I can do whatever I want, but this person who is putting the offer, who is there to buy that house, needs to understand that if I don't get a house, if I don't get a deal, this is not going to happen. And that's what that contingency is. Now, just to explain a little bit more, you could put all kinds of contingencies into a contract in order to fulfill whatever it is that you need to, to fulfill, to cover yourself for whatever it is that you have to cover yourself. So there's many more clauses. This is just a sample of the most used ones, but there is many more contingencies that you can put in your agreement when you're negotiating. Another reason why it is important that you have a good realtor by your side. I hope this video was a little bit more educational and better than most of the videos that I've done before, because I find those videos sometimes that are not giving so much information. So I'm hoping that the future videos I can put a little bit more information in them, so that it gives you more value for you to come to the channel and to share this content with other people. So I really appreciate that you're here. Thank you. Yes, and if you need to contact me, you can send me a text, you can subscribe to the channel right in here, or you can email me at antonygaleano@antonygaleano.com, or just call me 310-437-3343. Thank you for watching, and I'll see you next week.